Hello everyone, this is Professor Kent. Today this recording is homework for chapter 5, volume 1. Some of the questions we were unable to take up in the class, so what I'm doing is I'm recording some of the questions here. So the first question that we supposed to take it up was 516, and under 516 what the question is asking us to do is an indirect method of cash flow and a direct method of cash flow, and they only want us to prepare operating activities. They don't want us to do a full statement, full cash flow statement. They only want us to prepare just the operating activities for the company, for both using a direct method and indirect method. So the first thing we're going to do is we're going to start by putting the name of the company. In this case, the name of the company is Canal Transport. And what is the name of the statement? It is called, they're asking us a partial, it's not a full statement, it's a partial. So we can call it a cash flow statement, or you can say partial statement of cash flow. And for the year ended December 31st, 2020. So again, the first thing we're going to start from is cash flow from operating activities. And then the income we start with is a net income. In this case, they told us what the net income is. The net income we're starting off with 148,000. So the net income that we're starting with is 148,000. So that's our first number that we're starting it. Then we meet, this is again accrual income. We needed to adjust this income so that we can come up with a cash income. So what we're going to do is we're going to make adjustment to the net income. So adjustment to net income. What are adjustments we're going to make it? We're going to add back or subtract any non-cash items that are on our income statement. So if you're going forward, we have a gain on a disposal of an asset. That's our first one. So you're going to add or subtract. In this case, when you have a gain is treated like a revenue. Gain on disposal of building. No, actually it's not building, it's an equipment. So disposal of an equipment. In this case, they told us it's 25,000, and that 25,000 we needed to take it out. So 25,000 is a minus. So then let's put this to the side so we know that we are not adjusting that. So then the next one is we have a depreciation or an amortization expense. In this case, we would have a depreciation, because if you look at it, it's saying that additional information. Operating expenses include 70,000 in the depreciation expense. The company follows IFRS, and the interest is treated as an operating activity. So we know that there's a depreciation we needed to add back, which is 70,000. So we dealt with all the non-cash items. After that, what we're going to do is we are going to the reason why they don't want us to do the full statement is, if you look at it, there's no cash, so we don't know what we're balancing to at the end. So that's another reason why they don't want us to do a full statement. Now then we're looking at your current assets and your current liability. So if the current assets goes up, or the current asset can go down. If it goes down, it is, if you look at it, what's happening to your how do you know if it's going up or it's going down? If you look at it now, it went down. So if it went down, the money is coming in. If it's an increase, the money is going out. So the current liability works the opposite. If its current liability went up, it is a plus. If it goes down, it is a minus. So what's happening first? We needed to take the difference. The difference is $10,000. So is it increase or decrease? In this case, it is an increase. Oh no, it's a decrease. Sorry, it is a decrease. I'm making an increase, but it's a decrease. So it is a decrease, wherein a decrease is in accounts receivable. So if it's a decrease, then we know that it's going to be a plus. The adjustment will be a plus. And how much is going to be? It is going to be 10,000. Then the next one, we go to the prepaid insurance. The prepaid insurance, what happened is went up, and it went up by 3,000. So in this case, it is called an increase in prepaid insurance. Prepaid insurance, and that prepaid insurance is going to be if it's an increase, it will be a minus. And how much is that? It is a 3,000. So we dealt with that. Then we the next one we have to go to is my current liabilities. So the first one, we have an accounts payable. We needed to know what the change is. The change is 11,000, and then it is a decrease. If it's a decrease, that means we paid the accounts payable. It says a decrease in accounts payable. And if it's means we paid it, so it's going to be a minus of 11,000. Interest payable, it is an increase, so increase in interest payable, which is 1250. And if it's an increase, and it was going to be a positive in my operating activities. Income tax payable, then income tax payable, again, its difference is not 45,000, 3,500, because 45 minus the 8,000 gives you 3,500. So the difference first is 3,500, and what it is an income tax payable. Then we need to look at it, is this a increase or decrease? So in this case, it went up, it is an increase in accounts payable. If it's an increase, number will be a positive. Going further, what happened to unearned is also my current liability. So in this case, it went down, it went decrease in unearned revenue. And how much is it? In this case, it is 4,000. So what we're going to do is, if it's a decrease, and that we have to minus it, so that will be a minus. So we have dealt with all the APs and ARs, or in other words, current assets and current liability. Our next step is going to be, like you said, that you could it could be if the number is a positive or a negative number. So what we're going to do is we're going to make the adjustments, and we're going to total them up, and then once we total them up, the total amount is 41,750. And then from there, what we're going to do is we have a it is a positive number. This was a positive, this was a positive number. Our answer will be a positive. If number is a positive, it is called net cash provided by operating activities. And then add them up, and it will be 189,750. So that's the net cash from the operating activities. So now that was the first part of the question, was what was the net cash from the operating activities. But we're not left there, because we did the indirect method. Now we have to do the same thing. We're using the direct method. So now the next step, well, we're going to get the same answer, but how we are going to arrive to those how you're going to arrive to those numbers are going to be different. So let's look at each numbers and see what the question is asking. When you're doing a direct method, you have to go through each line, except you do not touch the subtotals. So subtotals, we don't do it, and we don't touch any non-cash items. The first item, we have a service revenue. When we have a service revenue, the accounts that we are connecting to the service revenue will be your accounts receivable and your unearned revenue. So those are the accounts that we are what we are dealing with it. Now, if you look at it, we have an accounts receivable. In accounts receivable, we have a balance. In our accounts receivable, we started off with 60,000. So that's the balance we're starting off with. What we're doing is we're going to end up with the 50,000. My current year's revenue, in this case, they told us in the question, I think it was 545, so it is 545. But in that revenue, we know that some of the revenue was earned, but we haven't received cash for it. So first, what we needed to do is we need to adjust how much we're adjusting. We're adjusting our 4,000 for 4,000 first. So in that revenue, we have unearned revenue in there, which is not the total revenue. In this case, difference between those two is 541,000. That's your on credit sales. And then what we're looking at, what we collected from the customer. So in order to do that, you have 60 plus the 541 minus the 50 will give you the number that you need. So let's see what number do we need. So 60 plus the 540 minus your 50 will give me 551,000. So that's the cash we collected from customers. So when you're doing a direct method, again, the name of the company will be there, the statement of cash flow. And then what we are going to do is the next step is going to be to do our statement of cash flow and then the date, cash flow, then the date. And then the date. So first thing we're going to start off with net cash flow from operating activities. From operating activities. Under there, we are going to say that cash received from customers. So it's a cash received from customers, which is you, if you're receiving money, money is coming in, and that is your 551,000. Then we go to our next one. What are we doing? We're paying for operating expenses, which is 370,000. Under the prepaid expenses, they told us that 70,000 was cash. So first thing we're going to do is we're going to adjust for that. So before we could do any, so we're going to pay cash. So it says cash paid for operating expenses. And then if it's a paid, it is going to be minus. How much is going to be? We need to look at it, how much is going to be. So when you're doing this, so when you're starting with the operating expenses, your total operating expenses was 370,000. So that was my total operating expenses. They told us in the question, there's a depreciation expense that is included in there, which is a non-cash item. We needed to take that out. So the cash operating expenses were 300,000. Then we needed to connect them to my prepaid, and we needed to connect it to my prepaid, and then we also needed to connect it to my words were lost, to my prepaid and accounts payable. So now if the first we are connecting it to prepaid insurance and we're connecting to the accounts payable. So if I were to do that, we need to make an adjustment for our prepaid insurance. So we want to know, did we bought some prepaid insurance, so that should also be if you bought it, that also is a cash. So when you have a prepaid insurance, we bought it. So some of the insurance this one was my cash operating expenses. You add the this becomes your total expenses, and then we have to add to that is my $3,000. That is your prepaid insurance. So then once you adjust for that, and then if you add it, then all the prepaid expenses that we paid was 303,000. From there, we want to know any of the accounts payable was also paid for those expenses. So then what we needed to do is, if you're looking at your accounts payable, we need a beginning balance in your accounts payable, which is 41,000. And then you need an ending balance, which was 30,000. So in this case, 41,000 was my ending balance, and beginning balance was 41, ending was 303. We know my operating expenses were 303,000. We want to know how much we totally paid for these operating expenses. In this case, it will be your you can take 41 plus the 303 and you minus your 30,000 will give you 314,000. So cash paid for operating expenses will be your 303,000. So that's how much we paid for our operating expenses. So the cash we paid was for the so the next one, when we are looking at it, we needed to go to our income statement to see what the next line is, so that we could see what we are trying to so the next one that we're dealing with is gain and losses. So the gain and losses are non-cash items. so that if it's a non-cash item, we don't need to deal with it. So gain on a disposal of an equipment, we don't need to deal with it. Next one that comes into our next one that we needed to deal with it is my interest expense. So the interest expense is 10,000. We needed to connect that interest expense to the interest payable account. So those are the two accounts we're connecting. So let's look at it, how we're going to connect them. So in this case, I'm just going to show it just at the corner here to see what we're going to do with that. So when you have an interest payable accounts, we have an interest payable and interest payable account. We started with the 750. We end up with the $2,000. My current year's income taxes was 10,000. We want to know how much we paid. So in this case, 750, you're going to add the 10,000 and minus the 2,000. That will tell you how much cash we paid for the interest. In this case, it should be 750. You add the 10,000 and you're going to minus the 2,000, and that should come up to be for the interest expense, it will be 8750. So that's we paid cash for it. So the cash paid for interest expense will be, so we're going to say cash paid for interest expense. In this case, it will be 8750. So that's the cash we paid. The next one, what we need to do is we needed to see what is the next one. The next one is our income tax. Income tax, what we needed to connect it to the income tax payable. And how we're going to connect it by doing the same thing what we did to the interest. We're going to be doing the same thing. So what we did to the interest payable. So when you look at it, we have an interest payable account. Income tax payable account. We started with 4,500. We're going to end up with $8,000. My current year's income taxes was 42,000. We're looking for this. In this case, it'll be 4,500. You add your 42,000 minus your 8,000 from it. It will give you, it will tell you that how much we paid for that. So 4,500 plus the 42,000 minus your 8,000 will give you 38,500. So that's what we paid, cash paid for the income tax. So the cash was paid for the income tax is so the next one we are going to deal with is cash paid for income tax payable. So that was our next one that we just calculated in cash paid for income tax payable, and it came out to be 38,500. So cash paid for income tax, cash paid for income tax, and we paid 38,500. And this is how we found out the cash we paid for the income tax payable. So that is, they both are, if it's the word paid, there will be money going out. If the money, if it's a positive number, it will be money coming in. Again, we don't have anything else in our net income to deal with. We dealt with everything on the current assets and current liabilities and your income statement. And then what we have is next is you have a net cash. Net cash, it could be used or it could be provided. So in this case, it could be both. So in this case, we're going to say the net cash provided. So it will be net cash provided by the operating activities. So the cash provided by the operating activities, that will be you add and subtract, and then you will get a number, and that number will be 189,750. So that we will get the same number that we got it using the same number that we used for the direct method or an indirect method. So the answer will be exactly the same how you arrive to it. Now the next part of the question, let's see what the question is asking us to do is from the perspective of the external users of Canali Transportation's financial statement, discuss the usefulness of the statement cash flow prepared by using either indirect or direct method. Now, if you look at it, the numbers are going to be same regardless of what method is using, direct or indirect. So if you look at it, we had the same number under the direct method, same number using the indirect method. So that doesn't change. The only thing that changes is why the what it does is to the external users, what it does is it allows them to assess the capacity that the company has to generate cash. So in other words, it's a positive number. So in this case, it is cash provided. So the cash flow is coming in. So what it does is it allows the users to assess the capacity of cash, and this allows the users to compare the performance and the cash flow of the other business. So that's what the external users will do with this statement. So it doesn't matter which method they're using, direct or indirect. That doesn't matter. So the next question that we had to do was 5.7. In the 5.7, we're going to do a cash flow, and they are asking us to both do direct method and indirect method. So first we're going to do a complete a cash flow statement, and then we're just only going to do indirect method. And only do the direct method. So the difference between the both method is the direct method of the operating activity. So that's what we're going to do separately. So let's see if we could do the next question and see what happens from that point. So let's do the indirect method. Again, when you're doing the indirect method or direct method, anytime you do it, we needed to do a cash. We needed to do as the name of the company is always going to be there, the statement, the name of the statement, and then the date. So these three things are important regardless of any type of financial statement you're doing. The first thing we're going to do is cash flow from operating activities. So that's our first one, cash flow from operating activities. And then we are starting with is net income. In this case, when we look at it, this is seems like an IFRS company. If it's an IFRS company, what we have is we have two type of incomes. In this case, we have a net income and we have a comprehensive income. When you have a comprehensive income, it doesn't matter if it's when we're starting with a cash flow always started with the net income. So when you have that, you dealing with the net income. When you're dealing with the net income, you bringing in the 13,000. So you will not bring in the 15,000. You will be bringing the net income because we start with the net income. The next step is that we adjust this income by adding non-cash items. So non-cash items are added. So what are some of them? You're going to have a depreciation, you could have a gain and loss on disposal. So in this case, we will have a depreciation. So let's see if you can pinpoint how much is the depreciation. Did they tell us? No, in the question they didn't tell us, but if you look at it here, number 2 is saying operating expenses include 10,000 in a depreciation expense. So the operating, it has a expense, and that expense is 10,000. So let's you add the depreciation expense, and that is your $10,000. Then there's no other non-cash items. I see they didn't tell us that, oh, there's no disposal. If there's no disposal, then we're not going to have any gain or loss on a disposal. So when the other thing we're going to look at now is your current assets and your current liabilities. So the first one, you're going to look at your accounts receivable. The difference between both is 12,000, and then we have to look at it as an increase or a decrease. In this case, it is increase in accounts receivable. If it's an increase, you minus the 12,000. Our next one is your inventory. What happened to your inventory? The difference is 1,000, and it is also an increase in inventory. And then what we needed to adjust it for $1,000. Going forward, you have a prepaid expense. The prepaid expenses are $4,000. The 4,000 is here. So in this case, the 4,000, what happens to your 4,000? It is an decrease. In this case, if it's a decrease, you're going to be adding it. So in decrease in what? It is in prepaid expense. Going forward, when we are going forward, is that the fair value OCI investment. Fair value OCI is not a current activity, but if you look at it, the OCI is related to our related to unrealized gain and loss, but we don't need to do anything at this point because we didn't adjust. The unrealized gain was not in my net income. It was only it was in my comprehensive, so I don't need to do anything with fair value OCI. So the next, I'm going to go to my accounts payable. Accounts payable, there it was an increase in accounts payable. If it's an increase, that will be a positive. In this case, how much is the increase? It is 15,000, so that is a positive number. Going forward, income tax payable. Income tax payable is our next one. So income tax payable, what happened to our income tax payable? Did it go up or down? It went down. So if it went down, we know that we paid some of the taxes off, some of our liabilities off. So when we do that, now what we have is we add and subtract what all the operating activities, and that is equal to your 15,000. From there, what we have is we have a cash flow from cash flow provided, net cash flow. You could have a positive number or a negative number. In this case, we do have a positive number, so we're going to add them together. That's a 2,800. If you have a positive number, is the net cash flow provided by operating activities. Activities. The next one we are looking at is your cash flow from investing, and that will be from the investing is where we investing our money. So it will be long-term assets or long-term investments, anywhere there. We could be buying it or we could be selling it. In this case, when we're looking at it, what we have is we have an equipment and we have an accumulated depreciation. They told us that there was no disposal, so if we didn't dispose any, that means we bought something. So we want to know how much was bought. So in this case, if you look at it, we have to connect number 5 to during the year Drupax acquired 8,000 of the equipment in exchange for a long-term notes payable. So now we wanted to know, we exchanged it, so we want to know what is the change actually is. So in this case, we started off with 159. We know that we're going to end up with 173,000. So they said that we purchased. So what we did is we purchased. If we purchase it, how much did we purchase? They acquired 8,000 of the equipment. So in this case, do we know the 8,000, how we paid for the 8,000? So first of all, we needed to look at the increase or a decrease in our equipment. So this, we know that one of the change is the 8,000 that we acquired, but there's other things that are happening here. So we know 8,000 will be in here, so that is there. But if you look at it, we didn't sell anything, but we are still not going to add up the number. So if you look at it, 159 plus the 8 minus your 173 does not give you that 173. So we needed to add something more. What are we adding here is we're adding 6,000. So now the other way to look at it is if you take 159,000 and we have a balance of 173. So 159 minus your 173, the difference between the both is 14,000. We purchased an equipment for 14,000. From there, 8,000 was that we issued a bond, and the 6,000 we paid cash. So we issued a bond, and then 6,000 would be paid cash for it. So now we only care about what the cash we paid. If we paid cash for it, so then what we look at is cash paid for equipment. So in this case, cash paid will be your $6,000. So in this case, cash paid is $6,000. So that's minus. So we purchased it. There's no other changes. So now we don't need to deal with the 8,000. 8,000 is a non-cash items. So 8,000 is our non-cash item. So the next one is you have a net. So in this case, we have a negative number. If you have a negative number, it's a net cash used. And what is used by investing activities? So net cash used by investing activities. And how much is that? It is 6,000, and that is a minus. Now going forward, we need another activity where that will be your cash flow from from financing, who's giving us money. So financing activities are who's giving us money. When we look at it, we look at it long term. We look at long term debt. We look at our common shares. We look at our preferred shares, and we look at any dividends that we are paid. So these are the items that we're going to be looking at it now. Sometimes they give us the dividends. In this case, I don't think they give us the dividends either. So if they don't give us the dividends, what we needed to do is we needed to adjust for those dividends. So let's see. I was trying to we needed to see what the dividends are, but we know that there's a payable. If you look at it, we have a dividend payable sitting there. Dividend payable sitting there. So if dividend payable is there, we have to have some kind of dividend. So if they don't give you in the question the dividend, so when you look at it, you look at your retained earning. Retained earning, we started off with 140,000. So the retained earning balance, we started with 144,000. We know we're going to end up with 148,000. So those are the things we know that. Now, before we go forward, we needed to know what was the net income. If the company has a net income, so the net income will go in here. If the company has a net loss, they will go in here. Either you have a net income or you have a net loss. In this case, we have a net income, and that net income was 13,000. So if we were to do this, we're looking for X. Our X will be our dividend. In this case, we're looking for X, which is your dividend. So how you're going to calculate it? You're going to say 144,000. You're going to add the 13,000, and you minus the 148,000. So what that does do is it gives you a 9,000 dividend. So in this case, it gives you 9,000 dividends. I'm going to do it one more time. Your retained earning beginning was 144,000. You add your net income minus your dividend equal to your ending retained earnings. So in other words, we're solving for X. If you're solving for X, everything goes to the other side. So 148 minus the 144,000 minus your 13,000, your X will be your 9,000. So this is we dividend declared. So there's a difference between dividend declared and dividend paid. So what we needed to connect it to dividend payable. So when we look at it, we connect it to dividend payable. We started off with a 0. We end up with a 5,000. We know that we declared a 9,000 dividend. How much dividend did we pay? We pay 4,000 dividend. So that's how much dividend we paid. So so the dividend paid will be 4,000. So dividend we paid was 4,000. So let's do the first one. Dividend paid to the shareholders is your $4,000. That's how much we paid. Now then, the next one we needed to look at is your long-term note. So if you look at your long-term note, we started off with 119,000. So you have a long-term debt, which is your 109,000. That's what we started off with. We know that we're going to end up with 84,000. So we started off with that. We are going to end up with that. If that's the case, what do we need? We needed to know what happens to the dividend, to the notes payable account. We know if you look at it here, during the year, Drupax acquire 8,000 of equipment in exchange for long-term debt. So we know that 8,000 was a non-cash item. What did we do? We debit the equipment. I'm just going to show you. You don't need to show me this. And bond payable, and that was for $8,000. So that was 8,000. Did we didn't retire any? What happened to our entry doesn't balance? So if we know that we purchased it was 119,000, we issued 8,000 of the bonds, and then we're supposed to end up with 84,000. What else happened? So what we are doing is we're solving for X. So in this case, you're solving for X, and we could do it either way. You could do it both ways. So if you put your X here, and then all you're going to do is 190,000 plus the 8,000, and then minus your 84,000 should give me my X. So let's see what that is. 109 plus your 8 minus the 84,000 gives me 44,000. So we also issued a bond for 43,000. So now our entry, our ledger will balance. You have a beginning balance plus your 8,000 plus your 43,000 should be equal to your 84,000. So so that'll be 84,000. So then when you're looking at it, how much actually you issued a bond and received cash for it for 43,000. So in other words, what we are doing is, oh no, it is 44,000. I made a mistake, a little mistake. It is 43,000. So it's a negative number. It's not a positive number. So it's a negative number. Sorry. So we repay the repayment of the note. So in this case, sorry, I made a little mistake here. The number is 43,000. When I put it in, I didn't do it right. So in this case, it will be 8,000 is here. And then we know we are going to come up with 84,000. So that was correct what I did. 119,000 plus your 8,000. You're going to do plus or a minus. That will be X equal to your 84,000. So now if you look at it, you have 127,000. That's the number. What we needed to do is we needed to minus, what we needed to minus is 43,000 to get your 84,000. So it is a minus number. When I carry to over, I didn't do that. In this case, if it's a minus, that is a 43,000. We paid, you repaid the loan. So you repaid the loan, not we issued a loan. So in this case, if you repaid it, the money is going out. So it will be a repayment. It will be a repayment of a long-term debt. In this case, it will be 43,000. So now what else do we have? We also have, next one is you have in your income balance sheet was common shares, statement of financial position. What happened is we issued common shares. How much common shares were issued? Difference between the both was 7,000. So if you issued it, the money is coming in. So if you issued it, issue common shares, the money is coming in. So issued common shares. That will be a plus. And how much is that? It's a 7,000. So now we have dealt with everything that is there. So in this case, 43 minus the 4. So add those two numbers, 47. So that will be my 40,000. And that is a negative number. So now when we are looking at it, what did we have? We have a net cash used by financing activities. So now we have a net increase or decrease. So what we're going to do is, I always think of it, you always going to add your A, your B, and your C. So A plus your B plus your C. If it's a negative number, it will be net used or net increase or decrease. In this case, if it's a negative number, it will be net increase. So in this case, it seems like a negative because 46 is negative, 28 is positive. So we were going to come up with 18,000. So 18,000 is net increase in cash. Then what we needed, we need a beginning balance in cash. Beginning balance in cash, and then we need an ending balance. Ending balance in cash. So in this case, what is the beginning balance? The beginning balance, you are going to get it from where? You're going to get it from statement of financial position. In this case, if you go up, we started with 38,000. We're going to end up with 28. In this case, it was a decrease. So this number is a minus. And then what we're going to do is we're going to add. What are we adding? We're adding the 38,000, which is my beginning balance, and I'm going to end up with the 20,000, which is the balance in my statement of a financial position. That's the balance. So that's what we start up. Now going forward, what we needed to do is we needed to do the same question. What we needed to do is using the direct method of a cash flow. So what are we going to use? We're going to use the direct method of a cash flow. So the second part of the question is using the direct method. We are asked to calculate the operating activity. So that's our next step that we had to do, is using a direct method. Again, the name of the company is always going to be there. You have a statement of cash flow and then the date. And the heading will be cash flow from operating activities. So the first thing we're going to start with is net sales. So that's the first thing we're going to start off with. If we're starting with the net sales, we needed to connect it. What are we connecting the net sales to? Accounts receivable. So that's what you're going to be connecting it. So if I were to look at accounts receivable here, we started off with the 74,000. Our current year sales are 323,000. We know we're going to end up with we know that we're going to end up with 86,000. So we want to know how much cash we received from the customer. There's no unearned revenue at this point. So you're going to take the 74,000 and you are going to add the 323,000 and minus the 86,000. That's how much cash we received from the customer. So cash received from customers. So then we're going to do it together. 74 plus 323 minus the 86 gives us 311,000. So the cash you received from customers is 311,000. So that's your first one. The second one is your cost of goods sold. The cost of goods sold, you're connecting it to your accounts payable and to your inventory. So first you buy the inventory and then you sell the inventory. So let's look at the first one. You have an inventory. From the inventory, what you're going to look at is your accounts payable. In this case, inventory, we started off with 102,000. We know we're going to end up with 103,000. That is already known. We also know that our cost of goods sold is 175,000. How can we sell 175,000 if you don't have that? So we have to purchase it first. So in order for us to do it, you add these two numbers and whatever is the total minus that from. So 103,000 plus the 175,000 minus your 102,000, that will give you what your purchases are. So in this case, 176,000 is your purchases. Then we are going to take this to accounts payable. You start off with 100,000. We know we're going to end up with 115,000. So in 115,000. So from there we purchase 176,000 worth of purchases. We want to know how much we paid to the supplier. So cash paid to suppliers or cash paid for the inventory, and that will be our negative number. So what we're going to do is you're going to take 100,000 plus the 176,000 and minus your 115,000 will be the cash we paid for our inventory. So 100 plus the 176,000 minus 115,000 will give me 161,000. So cash we paid to the supplier is 161,000. So now we know that we dealt with that. So I just like to cross it out because it makes our life a little bit easy when we are doing that. So inventory. So the next one is my operating expenses. The operating expenses, what it does is first we needed to deal with a non-cash item. So your operating expenses, did we pay all in cash? In this case, operating expenses, we started off with 125,000. We have a depreciation expense that is a non-cash item. We needed to adjust for that. Then what we needed to do is we needed to connect it to accrued liabilities. There is no accrued liability, but we have a prepaid expense. So in this case, some of this expenses was in there as an adjusting entry. So what we needed to do is the difference between the prepaid expenses are the $4,000. We needed to adjust for that. And that will be your prepaid expenses. We didn't pay cash for it. Some of the expenses is in there that are non-cash, that is an adjustment. So if you think about it, they would have done a debit will be an operating expenses and credit will be your prepaid expense. In this case, it will be a prepaid expense for the $2,000. So if this expense is a non-cash there, so we needed to adjust for it. So we didn't pay cash for it. So cash paid for operating expenses, and that is your minus, and that will be your 120 minus the 10, which gives you 110 minus the 4 gives you 106,000. So that is my 106,000. So that's the cash we paid. So let's see what the next one is, so we could deal with the next one. So next one is on our to-do list is your income tax payable. So we already dealt with prepaid, accounts payable. Now we're going to deal with income tax. So in this case, first we have an interest expense and then we have an income tax. So we needed to deal with both of them. So now same thing, what we want to know how much cash we paid. We did work it out before, but we're going to do it again. So the first one is interest payable, interest expense. We did not pay anything. We paid everything because there's no liability here. If there's no liability here, so cash paid for interest expense, and then the whole amount was paid. In this case 9,000 is a minus. Then we have a cash paid for income tax. That's our last one. Cash paid for income tax. So income tax, we didn't pay all the expenses. Some are sitting in our liabilities. So we started off with the 3,000. We know that we are going to end up with the 2,000. My current year's expenses was 6,000. We want to know how much we paid. So in this case, 3,000 plus the 3,000 plus the 6 minus the 2, we know that we paid 7,000 cash. So how did we do that? 3,000 plus the 6,000 minus the 2 equal to 7. The cash we paid was for 7,000. So now we have done with everything. We don't need to deal with other comprehensive income. That comes out of your other comprehensive income. So that is your 7. So now once we done that, so we had the answer was 28,000. We want to know, did we get 28,000 here? So we have a net cash. It was provided by operating expenses. By operating activities. In this case, if you add and subtract, we should get up with a number. That will be your 28,000. So this will be your 28,000. So that's the number that we have is 28,000. The next question that we had to do is 5.2. So let's do 5.2, which is a problem 5.2. So what we're going to do is we're going to do problem 5.2 and see what the question is asking. The question is asking us to do a classified statement of financial position in a good form. So we needed to do is statement of financial position. Again, when you're doing it, you start with the name of the company, and this name of the company is Montoya Inc. So the name of the company is Montoya Inc. And what are we doing? We're completing a statement. What type of statement are we doing? Statement of financial position. And then what is the date? The date is December 31st, 2020. So the first thing we're going to start with is we are going to start with current assets. So that is our first one, is the current assets. When we need to look at from the list which one is my current assets. Of course, the current assets starts with,
I can edit.
The first thing under the current assets, we are going to start with the cash. The cash is 360,000. So that's my cash. That is your 360,000. The next one that will come into that, the next liquid asset will be the fair value net income investment, and that sorry, my screen just moved. Fair value net income investment, and that is my next one, and next one under the current asset, and it is 121,000. In this case, 121,000 is the fair value of the asset. So that is the fair value of the asset. The next one, let's look at it on the list which one is going to go. So we know that these ones, and then we're going to go to notes receivable. Notes receivable is the next one is notes receivable, which is 445,700. These don't go there. Building doesn't go. And then we have an inventory. Inventory is 239,800, and that is your inventory. Going further, payables don't go there. Common share, preferred share, we have a prepaid expense. That is my next one. And that is 87 87,920. I don't think we missed any. If we missed it, oh, we did miss it. Income tax receivable, and that should be going after the receivable. So then in between, we are going to have income tax receivable. All the receivables go together before the inventory. In this case, it's 97,630, and those are all of them that we have. So it's a total current assets. What you're going to do is you're going to add them together, all those equal to your current assets. In this case, it's 1352,050. So that's my current asset. My next one is it'll be long-term investment, but I don't see any. The next one is property, plant, and equipment. So property, plant, and equipment. So that's the falling one. We're going to start with the in the thing is we have a land, so we're going to start with the land, and the land is for 480,000, and land doesn't depreciate, we know that. So the next one we have is a building. No, land is gone, so building is 1.6 million. 1640000, and then we have an accumulated less your accumulated depreciation on the building, which is right beside it. So that is your 270,200, and that what we have to do is minus it, and the minus it, and then the total amount subtotal goes to the side. So that is my subtotal. So then the next one that you have is equipment, and then we should have an accumulated depreciation on the equipment, which we do have it. So next one is my equipment. Equipment is going to be 1470123, and my accumulated depreciation is a less, and that is 292,000, and that is there. So that we have done the accumulated depreciation, we've done the prepaid before. That is equal to your 117,800. So you're gonna all add up all three, and that's the total of your property, plant, and equipment. And after that, normally we have an intangible asset. I didn't see any, but I do see a goodwill. Goodwill has its own account. It's called the goodwill. So it is a goodwill, and then goodwill is it's 125,000. And we don't see, there's no other other assets that are left. So then we have a total assets. So you're going to add up your total assets. So these are the three numbers you're adding up, and that will be equal to 4504 and 850. So that's the total total assets. So after we done the total assets, we needed to do is liability. Our next section is for my liabilities and equities and shareholders equity. And then first thing we come in that is after the liability is the current liabilities. So now this bank loan, we needed to know, is this due? When is this due? They didn't say anything when it's a due. So in this case, then we could take it as a current asset. But we always starts with accounts payable, and then there's no order after that. So we have an accounts payable, and that accounts payable is 490,000. So then we have a notes payable. Accounts payable, we have a notes payable, which is your 265,000, and then we're going same line. We have a bond payable, that's a long term, and that the next one is 177,591 is my bond payable. Going forward, we needed to know if we missed any. We already got that. Rent payable is also current liability. Rent payable is my current liability, and that is 45,000. So we taken care of it. We have income tax payable. Income tax payable, that is your 98,362. So that is 450,000. So income tax was there. That is a long term, so we don't need to deal with it. I think we dealt with all the current liabilities. So then that is equal to your total current liabilities. You're going to add up all these liabilities and it should equal to 1075953. So that's should equal to that. And going forward, the next one is going to be your long-term liabilities, long-term debt or long-term liabilities, same thing. So long-term liabilities, and those are, the first one we had was the bond payable. They were saying that no, bond payable due 2024, which is 217,000. So let's deal with that first, and then we'll do with notes payable of 1.6 million. So bond payable of 270,000. 270,000, and then what we have is we have a notes payable, and that was 1.6 million, 1600100. So we have dealt with notes payable, we have dealt with the bond payable, we have a rent payable that is long, which is 480,000, and I think we're done with all the long-term liabilities. So then we're left with common shares and preferred shares. So we're left with common shares and preferred shares. So let's go forward. We had a rent payable, and that was for a long term, and they said that it's due 2024, and that is my long term, and that is 480,000. If I'll add it all together, and that's my long-term liability 2350000, and then that is next title is my total liabilities. You're going to add your current liability with your long-term liability, and that is 3,425,953,000. After that, we have shareholders equity. That shareholders equity will be is going to be under there. We are going to have a capital shares. Capital shares are your both preferred shares, and you have a common share. So we had both. And when you're doing it, they tell you how many shares are authorized and how many shares we have. In this case, they said preferred shares 15,000 was issued. We don't know how many were they authorized. In this case, they did tell us they unlimited common and 20,000 of preferred shares were authorized. So when you say that, we needed to put it in how many authorized and how many was issued, so the users of the financial statements can see that. So we have preferred shares, and the preferred shares were 200,000 shares were outstanding, 20,000 shares authorized, and 15,000 shares were outstanding. So we needed to let our audience know who's looking at the financial statement, and they were 150,000. And the same thing with the common shares. 20,000 shares were authorized, and how many were outstanding? I think they were saying that unlimited common shares were outstanding. I think I'm going to go back and read it again, what the question was saying. Unlimited common shares and 20,000 preferred share was authorized. So common share, so first thing is going to be common shares, and that unlimited authorized, and then how many and then the 20,000 was outstanding, and the amount was 200,000. So that's the amount. So now that is the amount. So now we know that what else we're left with. We are left with the retained earning, and they didn't tell us what the retained earning is. So in other words, we needed to know what the retained earning is, because we don't know that. But we know our total liabilities and shareholders equity is equal to our total assets. Shareholders equity, that is, we could figure out, because we do have the current assets, which was 4,504,850. So let's put that in here, 4,504,850, and this is the only X we have. So then if I were to do that, you could just kind of 4504850 equal to your liability. Our liability is 3,240,000. This is my asset, this is my liability. Under my owner's equity, we're just missing one thing. So 953 plus we already have 150,000 and we already have 200,000, and then what we are missing is we're missing plus number is my x. So then all we're doing is solving for this x, and then you could do it either way. You could bring everything to one side, and then if you're doing it, that add all these numbers up and then minus it from your from your assets. So 3425 5953, you add your 150,000, you add your 200,000, gives me 3775953, and they both should be equal. And if I take a minus from these two numbers, minus 4504850 equal to your if I minus those two numbers, it's equal to 728,897, and that's the number is for my retained earnings, 728,897. And what you could do is you can add this number, add this number, add this number, and that add number, that should be equal to your total liabilities and owner's equity. Thank you for listening to me, and that's it for all the questions for today. Do let me know if there's any questions. Let me know in the class, or reply, send a message on under the video if there's anything you wanted me to discuss. Thank you so much for listening to me. Take care and bye for now.